Welcome to the podcast, Andrew. We're
Thank
excited to
you.
have you. So, you've spent a good amount of your career in payments, and now you're writing, in my opinion, one of the best payments
Oh, well, thank
newsletters
you.
in the space. Um, could you tell us a little bit about what got you into the industry, what you've worked on, and what inspired you to start writing?
Sure. So, uh, when I graduated from college, I had no clue what I was going to do. I had some coding skills at the time, which was pretty rare in 1980. And I got a job at the American Bankers Association. They needed uh, a programmer. And so I joined them, and that was my intro to the banking industry. I spent about 18 months there, and then I became a consultant working with one of the big audit firms at the time. And from there, it was consulting job after consulting job, more and more focused on banking or finance technology and increasingly on payments.
Mhm.
I would say for the past 25 years, it's been exclusively payments. And then after being a partner at Oliver Wyman Financial Services for about 10 years, I was approached to be the head of payment strategy at JP Morgan, where I spent 5 years. And Zelle is one of my projects while I was there, but I also did work in the early days of crypto. Stable didn't even exist back then; it was old crypto. And then after that, I spent 5 years as a partner at McKinsey's payments practice, and now I do a variety of things, including payments at full.
That's awesome. That's a really interesting background. I'm excited to dig into some parts of that. So, you've talked about, and I'm sure you've observed that payments innovation typically takes 20 plus years to saturate, which you've written about. And you say that's also true for things like Apple Pay and will be true for stablecoins. Could you talk a little bit about the history there and why does that timeline still apply?
Yeah, so there's been wave after wave of innovation in payments, and there's always some great new thing that's panicking the banking industry. Um, but basically, it takes a lot for people to change their payments behavior.
Mhm.
What generally happens is there are a rush of people early on who embrace it. Early adopters, that's the common expression. And and those people tend to be young and well educated. And so if you look at the early adoption, it's like straight up. But then you run out of those people. And then you have to sell, you know, less technologically savvy people in their 20s, and then people in their 30s and 40s and 50s and 60s. And so what typically happens is it's a generational thing, right? As those people in their 20s who have adopted get into their 30s, the rate of adoption just climbs. And as sorry to say, the older people pass and are replaced by younger people who are more adoptive, the average usage just goes up.
Mhm.
So you see that in payments, but you also saw it in like mobile banking adoption, right? You can see exactly the same curve. And in that article that you're referring to, I found some curves that show precisely that. Online banking, that kind of banking, bill pay, automatic bill pay, PayPal, they all have that same growth curve where an early cadre adopts rapidly. And then to get it into the entire population literally requires generational turnover.
Mhm.
It's just the way things seem to go. And I think one of the reasons is that a lot of these things only marginally improve on what they replace. And so, Apple Pay is possibly the exception. Although, in the industry, we all said, well, how is Apple Pay any different to do this with your phone than do this with your card, right? It wasn't where it was a big change, huge, was in app, right? That you could pay for things in an app with Apple Pay. Whereas if you wanted to use a card, you had to type the number in.
Yeah.
And so that's where early adoption was, had hockey stick growth. It was very slow actually to penetrate in tap and go. And then later they penetrated the desktop internet. And I'm a devotee. Like if they don't have Apple Pay, I'm not interested.
Yeah.
so, um, so, you know, often these things are not massive improvements over what comes before. And it appeals mostly to a younger generation whose payments habits are not ingrained yet. And then it's just a matter of waiting for those people to age into their high earning years and for retirees to pass from the scene and get replaced by younger retirees who are faster to adopt. So it's that kind of pattern.
Yeah, that's really interesting. Um, Kind of looking at PayPal, which is an interesting story in payments right now. Um, they were a category creator, built a global network, but the core product's starting to stagnate. Um, is that because of this kind of adoption timeline that you're referring to?
When I was at JP Morgan, I could actually look at our customers who were using PayPal and look at what their demographics were, how much usage they had, um, who was adopting and who wasn't. And what I saw was precisely what I told you was the average age of a PayPal user was actually quite old. And it was the people who adopted around 2000 when PayPal became a big thing and e-commerce became a big thing simultaneously. Those are the people who were still on PayPal. But if you looked at younger cadres, they were either using Apple Pay or, Amazon. You couldn't use PayPal, and yet everybody was doing most of their e-commerce on Amazon. And so that sort of got people habituated to using card on file and eventually using Apple Pay and other methods. So I don't think it's so much that PayPal stagnated, is that when PayPal was adopted, when it was new, it really was unsafe to shop online. Your card credentials would be stolen. None of the retailers were well known, so you didn't know if it was even safe to embed your card with them. As the years have gone by, 25 years since their invention, you feel so much safer shopping online than you used to.
Yeah.
Amazon is still 35 to 45% of it all, and everybody trusts Amazon. Shopify is another 15%. So all those small merchants that used to be scared to shop at, that you'd lose your payment credentials and you would use PayPal for, well, now you have Shopify aggregating them, and you can pay with Shopify Payments or Shop Pay, which is their wallet. And so the fear has gone out of the system, and therefore the need or the desire to use PayPal to protect your card credentials has gone out with it. And so I think that's, one of the things that is hurting them in this process is that the market has just changed, right? The e-commerce is incredibly dominated by the biggest players, and often PayPal is either a secondary payment method there, where they have their own primary, or they're not accepted at all, like at Amazon. And if you're not accepted at a e-commerce merchant that accounts for 40% of traffic, you have a problem, right? They will say in their predictions that something like 70 or 80% of merchants accept us, and I'm sure that's true. But if you did it by dollar value, it's nowhere near that high.
Yeah. That's really interesting. And PayPal's attempted to do things to kind of stay afloat, like Pi USD. I feel like, and jury's out there if they had executed on Pi USD the correct way. Do you think there's a reality where PayPal becomes competitive again?
I don't think of myself as a betting person, but I would say that it is hard at this point because, again, if you believe that the impetus to use PayPal was safety, the original reason for using it, and I'll point out, when PayPal was new, it became the default payment method on eBay. And eBay, you're too young to remember this, but they were the Amazon of their day. Right? They were the first big e-commerce property and had very high share in the early days. So a lot of e-commerce traffic was on eBay. eBay defaulted to PayPal, and the merchants defaulted to PayPal because they needed to accept cards, and that was the only way to do it. And so when they went off eBay, they took PayPal with them. That part of the ecosystem is now Shopify, right? Small merchants aggregate on Shopify or Amazon Marketplace or other venues that have their own payment methods to allow smaller merchants to accept cards or other payment methods. And so there's just, again, I'll go back to what I said before, the unique niche that PayPal had and successfully exploited in a good way is just shrinking, right?
Mm.
In terms of PYUSD, one of my pieces, I said that I thought that was one of the things that they could ride back to success. I've, since writing that, I think it's still possible because they have merchant acceptance, right? So That's the big trick with stablecoins is no one accepts them. But PYUSD could be accepted by all of them. I think the problem is that you're not allowed, now that the Genius Act is out, you can't pay yield. And one of the things they had going for them is they were paying rewards. So now there's no particular reason to use a stablecoin in commerce. It's mostly to be cool. It doesn't accept cross-border. It doesn't really have any benefits over using a card domestically.
Yeah.
In fact, there's some drawbacks like consumer protection and chargeback rights and all the rest of it. In cross-border, it's a killer app, and PayPal has lots of cross-border traffic, but they publish data on that, and it's a fraction of their total volume. So where PYUSD could help a lot is making those transactions stablecoins instead of MasterCard or Visa.
Yeah.
But it's such a small fraction of PayPal's traffic that I don't think it would generate enough revenue to really restore their position.
Yeah, that makes sense. I'm curious to hear a little bit more about your time at JPM when the banks had come together to develop Zelle, kind of in response to the insurgents coming to light like Venmo. Curious to hear about what was that like, and what did you learn about how banks innovate during that time?
Yeah, it was. I'm still friends with the 5 representatives of all the banks that got together, the 5 other representatives plus me to form that thing. It was a once in a lifetime kind of opportunity. The whole idea was hatched at a clearinghouse meeting, TCH, the clearinghouse. And they were, concerned about sort of losing digital engagement to Venmo, Cash App, and there were a bunch of others at the time. They were investing billions in their own mobile apps and websites. And yet, the average Venmo user was using Venmo 5 or 6 times a week. And they were using Chase.com or Chase mobile app once or twice a week. So they were worried that the digital engagement would shift to the P2P apps. And then those players would start offering banking services and start this generational shift that I talked about earlier, right? If you capture 20-year-olds, eventually they're 30-year-olds and they have real money. And those are the people that, bankers want to bank. So that was the concern. They also wanted a safe way to push cash and checks out of the system, which has been a long-term goal of the banking industry, is to less paper because paper's expensive, fraud prone, et cetera. So we all came together. Strangely, interests were not entirely aligned. Some people in the room wanted to go to commerce quickly. Some people just wanted to do P2P. Some people wanted a standalone banking industry P2P, because Venmo was standalone. Cash App was standalone. So we should be standalone. And others said, wait a minute, the whole idea is to anchor consumers to our digital properties. It should be part of the Chase app, the Bank of America app, the Wells Fargo app. So we had these debates for, several months, and eventually coalesced on the plan to default to Zelle being commonly branded, but part of the bank apps. But if you wanted, you could have a Zelle app as well that you could offer to your customer. And then we had a standalone Zelle app to serve all of the customers of banks who weren't Zelle members. So that was the original launch plan, was basically a dog's breakfast of options. And eventually, as it made its way into the market, everybody wanted it to be part of the bank app. They actually didn't want a standalone app. They only used Venmo as a standalone app because that's the only way you could get Venmo. So it wasn't a choice or preference. It was the only option. We sort of felt our way through to the ultimate solution. When we sat down to do this, we said the proposition of Zelle was going to be 2 things. Number one, you already have it. It's in your bank app. Everybody has their bank app on their phone. And, growth rates for mobile banking adoption were in that hockey stick phase. Number one, so it's convenient because it's in your bank app already. And number 2, it settles directly into your checking account. So unlike Venmo and Cash App, where you're settling into a stored value account, it seems like it's real time because it's real time from Venmo to Venmo. But try to spend that money. Like you couldn't spend it on anything. You had to push it back into your checking account, which you could do for free, but you had to wait a day or two for the money to arrive. Or you could pay. I think it's currently 1.75% of the face value, and you could have it go immediately. Whereas that feature of Zelle was free. And I think that's what ultimately, and we set those in stone in 2014 or 15. We launched 2017. It was actually dinner with my son a few years back. He and his friends were in their low 20s. And he introduced me as being one of the founders of Zelle, which I didn't even know he realized. Right. We talked about it at the dinner table all the time. He's totally checked out. All he cares about is, games and stuff. But he introduced me very proudly as one. And his two friends, who were both in their 20s and exceptionally cool, I mean, way out of my league, said, "You're Zelle, we love Zelle." And I said, I actually went to them and said, "Wait a minute, at your age, aren't you Venmo fans?" I mean, I'd seen the demographics. I knew young people grab. They said, "Well, if our counterparty is a Venmo user, we use Venmo, but our preference is Zelle." And I said, "Why?" They said, "Well, it's already in my bank app and it settles directly into my checking account." So, I mean, it's one of those rare cases where we got it right from the beginning, and we just had to wait for the audience to catch on. And they have, right? Zelle today is bigger than Cash App and Venmo combined and growing faster.
Yeah.
So it was a great experience, and it's a great product.
Yeah. It's really interesting. A great example of how banks came together and kind of innovated. Um, I feel like we're seeing a little bit of that now, where they're coming together, banding together against stablecoins, especially around the fear of deposit flight.
Yeah.
Um, do you think that we're going to see more of that kind of reaction from banks, where they will come together and try to formulate a different solution for what's happening, at least with stablecoins?
Yeah, it's interesting how the industry works. Is initially the biggest banks will try to go it alone, and we're in that phase right now. JP Morgan, Citibank are the two biggest cross-border banks among all the big banks. Both have tokenized deposits that they are using in corporate treasury services applications. So if you want to move money from London to Tokyo with JP Morgan, you can do it via tokenized deposits. But it's really a JP Morgan on JP Morgan transaction. It just happens to use a blockchain to move the money instead of the old correspondent banking system, or even older book transfers across JP Morgan's books. The same thing with Citibank. What they lack, and this is the same problem we had initially with Zelle, right? I did skip that part of the story, but JP Morgan, Bank of America, and Wells Fargo all had P2P systems before Zelle came along. They just weren't interoperable. They were real time on us. So if you were a Chase customer and I was a Chase customer, you could use Quick Pay, it was called, and it would operate in real time. And the same thing at Bank of America and the same thing at Wells Fargo. So they realized that the problem was, no bank has more than about 15% of consumer share by law, actually. And so the only way to get ubiquity and a common experience was to come together. The same kind of thing is happening around tokenized deposits and stablecoins, for that matter, because the tokenized deposits for large corporate cross-border transactions works great, but they're not interoperable. And so the only way to make something interoperable is to come together as a club. And so there's lots of discussions going on in the industry about, how to make tokenized deposits more interoperable. And if they were interoperable, they would be adopted more by users. You've read my stuff, that I'm very skeptical of, blockchain-based payment methods being widely adopted for domestic transactions. I'm a huge believer in their utility in cross-border, but domestically, I just don't get it, right? It's, we just spent the last 10 years building real-time payment systems, FedNow and the TCH RTP system. They're cheap, they work, they're real-time, they're instant, they carry a big information load. They have pretty much everything that a blockchain would have. except smart contracts, right? They don't have that, but no one's using smart contracts right now. I can't think of a good use. It's a brilliant idea. I can't wait for a smart contract use case to come up. It's just not there yet. So, to the degree that, they can make tokenized deposits, a thing domestically, it will have a smart contract dimension. And so if anybody ever invents a use case where you can use the technology, they will be able to do it with tokenized deposits. But we're still waiting for that. And then I should mention that the other thing that's unique about blockchain-based technologies is you can be infinitely divisible. So it really can solve micropayments, which is a huge, long-standing problem in payments that no one in any of the conventional payment methods could be both real-time and cheap enough to support micropayments. It can be cheap enough, and that's the ACH system, but it's not real-time.
Mhm.
Or you could be real-time, but then it wasn't cheap enough. And so things like agent-to-agent payments, I'm not an expert on this, but everything I read suggests that that's going to be a thing. They may pay each other a penny or two a transaction, or even a tenth of a penny a transaction. There's no way to do that today.
Yeah.
Right. You could do it with book transfers and gold wallets, like in gaming and things like that. But you could do it also with a stablecoin or a tokenized deposit or something like that. And I think that's a use case that will eventually emerge on either stable or tokenized.
Yeah. And kind of on the topic of agentic commerce, it's prophesized that it will change the way consumers purchase. And it makes sense that stablecoin rails win this because agents prefer to optimize for low cost and speed. Is there a reality that payments networks could have some leverage here against native stablecoin rails with agentic commerce?
I am, I'm a skeptic on most things, but I'm very skeptical of agentic commerce. Not that it isn't a great idea, right?
Yeah.
It's, one of these things like smart contracts that just makes so much sense until you try to find the use case, right? What I see happening is that the biggest retailers are not allowing third-party agents to scrape their data, right? Their robot.txt files say do not scrape. And that's what the Amazon Perplexity lawsuit is about. Is Perplexity is scraping, even though Amazon has their policy that you don't scrape us. If you can't get the data, then the agents can't make the case to the consumer that I'll always get you the best price and the best selection.
Right.
And so, so that's one side of it, is that all the big retailers are putting on us agents in place. So Amazon will have a proprietary agentic commerce engine on Amazon. Walmart is outsourcing that to ChatGPT, but Chat can't use Walmart's data on a general agentic commerce engine. They can only use it for on us commerce on Walmart. And most of the big ones are doing that kind of thing. The other thing is that I think, for branded goods where you know exactly what you want, agentic commerce can go and find the lowest price for you, easy peasy. But anything that you don't know exactly what you want yet, which is where the real promise of it is, because you could do that on Google Shopping today, right? What's the lowest price for a bottle of Heinz ketchup or something like that? My favorite example. But, if you want something that is not standardized, like you need an article of clothing for an event, or you want a pair of shoes or furniture or any of these categories where, a ton of shopping is done and a lot of search has to be done to find what you want. That's really the promise of agentic commerce. But I haven't seen any evidence yet that agents can divine what your taste is, right? Like,
Yes.
am I going to like that? Do I like the color? And fit is the other problem. Is it going to fit me properly? Because a size 8 is not always a size 8. I know I have a problem with shoes, is that I'm generally a 9.5, but sometimes I need a 10 and sometimes I need a 9. And
Mhm.
sometimes they don't have half sizes. So I have to guess. And I, you know, I don't know how you solve that problem.
Yeah.
I mean, there have been attempts to do it repeatedly to, you know, take pictures of your feet and then have a database of shoe size, which manufacturer's shoe sizes are going to fit your feet perfectly. I ordered some sneakers a few weeks ago, um, and they arrived and I love them. They were like awesome. And I put them on and I have low ankles and they rubbed against the bottom of my ankle.
Yeah.
And so they were a size 9.5. They fit perfect. They looked great. So they got the taste right. Uncomfortable as hell. I have to send it back.
Yeah.
And I expect that that's the experience we're going to have with agentic commerce for a long time.
Yeah. Unless you feed it every single data point about yourself.
I mean, I thought of things like, you take your favorite items of clothing out of your closet and you take pictures of them.
Yeah.
And you feed that into the database. And then it somehow knows either from other people or from cooperating with the manufacturers whose standard size A fits similarly to this. But that's so much work to set it up. It's hard to believe that that is actually going to happen. One of the articles I read about what Walmart's doing was, the problem in all agentic anything is getting the prompt right. And what they talked about for the Walmart chat thing is a term they called conversational commerce, which is the AI inquires, it sort of leads you through a Socratic dialogue to write the prompt, right? Do you like, this blue or that blue? Or do you, like long sleeve or short sleeve? Or, these fabrics or what kind of neckline or whatever. And it helps you specify more and more what you really want. And then it does the search instead of just going out and finding you stuff and, you don't even know what you wanted to ask for.
Yeah.
I've been investigating snowblowers because I've reached the age where shoveling, as much as I love doing it, it's probably not the best idea. And so I went out and tried to learn about snowblowers, and I found out that I don't actually want a snowblower. I want something called a snow thrower.
Oh.
And I didn't know there was a difference, of course. And then I wanted electric. And so that narrows the field. And then it turns out my driveway is fairly small, right? It's more like a 2x2 driveway. And so there are different devices for small driveways and big driveways, and different devices for deep snow and small and shallow snow. And I could not have written a prompt until I had educated myself that would get me a reasonable result back.
Yeah.
And so I think that's the challenge here, is that where agentic commerce is particularly useful, it's particularly difficult to write a prompt.
Yeah.
That because you, the consumer, are not educated enough to know what to ask for. And so this idea of the agent helping you write the prompt and then finding the goods, that idea appeals to me, but I haven't seen that other than this Walmart press release.
Yeah.
I haven't seen that in the wild.
Yeah.
And then, as you know, ChatGPT just changed the way it's going to do agentic commerce in that it will do the search for you, but then it's going to have an app for each major retailer, and it will drop you into the retailer's checkout to pay.
Okay.
And so, if you go at the technical definitions of agentic commerce, it's autonomous end to end, right? Well, it's no longer end to end. So it's agentic search. It's back to agentic search, which is great. Like, I would use it every day, but it's not the original vision of agentic commerce where you just say, I want this, and they go and find it and it shows up at your door. I think that's years and years out because of these intractable problems like taste and fit, and, educating the consumer and getting the data scraped from the retailers and the manufacturers and that sort of thing.
Yeah, that makes sense. We're still pretty early. So kind of looking at what's happening right now with agentic commerce, regulations changing for both AI and also stablecoins, and then with stablecoins just accelerating in general. When you look at payments, what are some of the players kind of outside of what we talked about that are on the offense or defense right now? And is the landscape different this time for some of the incumbents, given all these
I think,
things changing?
it depends on whether you consider folks like Adyen and Stripe incumbents or insurgents. I mean, they've been
Mhm.
insurgents forever, but they've
Yeah.
been around now quite a while. So are they becoming incumbents or not? But I think both those companies are on their front foot. They're ahead of most of these developments. You brought up steering to stablecoins earlier, and Adyen, in their more recent earnings report, had a few sentences way deep into their shareholder letter that announced a program where they were going to convince consumers based on an analysis of their buying patterns. They're going to pick consumers who are likely to be steered, and then they are going to make offers to those consumers to switch payment method, um, to either stable or real-time payment or something like that instead of a card on behalf of the merchant. And so the merchant will do better because it's a cheaper payment method. The consumer will be selected for the likelihood to say yes and will opt in, right? So it's not you're not forced. Uh, and I thought that was really interesting. And Adyen will use that to differentiate itself because it showed some data on, conversion rates and cost savings from doing this.
Yeah.
And so instead of, just being selected based on how many fractions of a penny per transaction you charge to process a card, they will be selected on how much you raise my conversion at a lower payment method cost, payment cost of acceptance. And I thought that was really interesting. And, they've been doing that kind of thing forever, of helping the merchant improve their business, not just process the cards. And I think that's where they are way ahead of, not Stripe. Stripe does that kind of thing too, but way ahead of the more conventional acquirers.
Yeah. That's really interesting. Kind of considering all these changes happening at once, um, what are what are some things that merchants and payment companies should be thinking about right now? Or are we so early, with agentic commerce and even stablecoins a little bit, at least in in the US, that we don't know what to optimize for?
Yeah. And, you know, th- this is where the payment networks come in. I mean, for as long as I've been in the business, they hop on to every new trend, no matter what it is, because they are rightly concerned about being displaced, that someone will go around them or someone will come up with a new payment method that threatens cards or whatever. And so they tend to invest pretty much in everything, and they have been on their front foot with agentic commerce. Now, if agentic commerce ends up being agentic search, well, that investment is a big waste of time, right? Because if like the chat GPT model, right? If they drop you in checkout, but they don't check you out, the merchant does that the same way they've always done that. Well, nothing's different, right? You end up in checkout differently, but checkout is identical. And so that may have ended up in hindsight looking like wasted effort. I don't think it was wasted effort because who knew, right? And I lived through the same thing. I've written about this before, but I don't know if you folks remember big, the equivalent craze on Internet of Things. Your refrigerator was going to buy your milk for you.
Yeah.
You wouldn't even have to think about it. They would just look, and when the milk was low in your refrigerator, they would put an order in with the grocery store. Same thing. You were going to order your Starbucks from your car, and so every car manufacturer wants to control the infotainment system, and watches, did kind of work, but they didn't think for you. But none of that stuff happened, right? It all ended up being on Apple Pay or Google Pay, and you used your phone to do virtually all of that. And the card networks were already in the phones, right? So they did the same thing they're doing with the agentic now. They were doing with Internet of Things then. Back then, the big thing was tokenization. So they came up with provisioning utilities to put tokens into watches, to put tokens into what are those things called, the heart rate trackers and Fitbits, and things like that. And we at JP Morgan integrated with all that stuff, and then never had any volume because no one cared. So, whenever one of these crazes comes around, the networks are rightly paranoid. And so they have plenty of money. So they invest in being central to the ecosystem. And then if it doesn't happen, well, they have plenty of money. So,
Yeah.
at least they, no one could accuse them of missing a trend. And then every once in a while, like Apple Pay, they do that and they're ahead of the trend because, Apple Pay is pretty large and the networks powered in the sense that they developed the whole tokenization technology to provision tokens into Apple Pay. And that tokenization has become central to pretty much all of card processing. So there is a case where it paid off to have been paranoid and ahead of the game.
Yeah. I do appreciate how maybe skeptical you are or critical you are about some of these things that are happening. Agentic commerce, we're early enough that maybe in 5 years things are going to be so different than 20. I'm curious about how you're thinking about stablecoin adoption, especially in the consumer side in the US, because it's obvious globally where it's being used, but I'm curious where you think there.
I was at a conference, I don't know, early last fall.
Yeah.
And somebody from one of the big crypto companies, not crypto companies, but blockchain technology companies, got up and gave a speech. And I love this company, right? They were a fabulous company. I'm a big admirer. But they got up and they said, and I think they said they expect within 5 years that 90% of all payments will be stablecoin payments. Not cross-border payments, not whatever. 90% of all payments will be stablecoin payments. And, having lived through wave after wave of payments innovation, I was skeptical, shall we say. So I got up afterwards and I said I would be shocked if 1% of payments are stablecoins in 10 years. And I just think this thing of it's very hard to get consumers to change their behaviors. And at least domestically, which is where virtually all payments activity happens, other than the smart contract thing we talked about earlier, how is it any different? I mean, does it really help the consumer? And I don't think it does. And it's not consistent with our regulatory environment, like doesn't have chargebacks. It's not Reg E compliant, Reg Z compliant, all that stuff. It doesn't offer credit yet, right? So, if you don't get your 30 days free flow, like that's worth a lot of money to a lot of people. Forget about rewards, but which you can't do either. So it's basically another version of a debit card or another version of a real-time payment. And those already exist and they're ubiquitous and they're backed by, giant companies also. So look, I like to say this lately because, just a confession, it's really easy to be skeptical because 95% of the time you'll be right simply because most good ideas don't work. So you look like a genius when you're really not. You're just always saying no. And, most of the time you're right because most of the time things don't work. There are things that I am enamored of. And I think stablecoins are something real.
Yeah.
I think they're going to hit cross-border first and they're going to sweep the field, right? You can look at all the cross-border fintechs, all have strategies to adopt stablecoins to move their own money, right? So they might still be in conventional payment methods to get money in from consumers or companies, but then they're going to move it across their own books on a stablecoin because it's so much better than the correspondent banking system. And so it's really having an impact right away in a pretty big, important, profitable use case, but there's no equivalent to that domestically. And so the people who think it'll sweep the field domestically, I just don't agree. But cross-border, I'm all in. I really think it is going to change the world.
Yeah, this has been really insightful. But to wrap up, so building in payments right now, and always it's a very costly venture because you're dealing with a lot of compliance. For builders out there that are building within payments, do you have a piece of advice for them in today's environment?
One of my favorite expressions or quotes, which I have in a lot of my pieces, is from a Andreessen Horowitz employee whose name I forget at the moment. But it says in the battle between every incumbent or every startup and every incumbent, the question is, will the startup get distribution before the incumbent gets innovation? And you see that play out over and over and over again. Banks are actually very good partners for distribution. And you often see a trend where fintechs try to go on their own and do distribution themselves, and the CACs just kill them. Right? It's very hard to aggregate consumers, particularly if you're on the innovation frontier. Well, banks may be slower in innovation, but they have tens of millions, hundreds of millions of customers, and they can be good distribution channels. So this idea that you have to own your own distribution, I think, is the advice I would give. I don't think you do. That B2B to C models, where you provide technology to a bank, and the bank then aggregates the consumers, is something that they really ought to think about, not necessarily do in every case, but they ought to think about the option. And there are people other than banks you can do it with, like you do it with Amazon, you could do it with Facebook, you could do it with Google, this is Apple in particular. There are ways to do that. And, the margins are very different, depending on which model you adopt, but so are the costs. And I think that's where people are often, not thinking it through.
Yeah.
I mean, I wrote about this a lot, but if you look at Chime, Chime's been very successful. They have a really interesting product. I'm very critical of them for other reasons, but they're undoubtedly innovative and successful. They spend more on marketing for their, I can't remember how much their revenue is, but it's low billions, than PNC Bank does with 500 billion in assets, like multiples more. Why? PNC Bank has branches. Everybody's critical of branches. Branches are dinosaurs, but 95% of you Americans, that's how they open their bank account. And so, if you want to go direct to consumer, which is what Chime does, you have to spend a lot of money on advertising and marketing and promotions and whatever. And that's often missed, right? All you see is the revenue side or the customer count, and you're not counting the cost to get that. So that would be my advice, is to think about distribution costs versus growth and revenue. And often what you'll find is partnering makes more sense.
Yeah, that's a great note to end on. Thank you so much for joining us.
My pleasure.